That's a lot of coffees just by being smarter with your money, and it'd be a better strategic option for you to make sure you're maximising what you've got, rather than cutting out your coffees and going through the stress of micromanaging every single transaction that you've got.
It's crazy to think, isn't it, that you can make little changes like this, and if there is still, those little indulgences that you love that you don't want to give up, you don't necessarily have to.
Jared, welcome back to episode 8 of Your Wealth Playbook, the no bullshit guide to building wealth. We're going to talk about a little lie.
We are going to talk about a little lie, something a lot of people talk about, the little latte lie.
The little latte lie. Tell me more. What's the little latte lie?
So you've heard everybody talking about the fact that you should just cut out your daily coffee, save your $5 and that'll get you a house. Or what about the avocado toast? Have you heard that one?
I've heard the avocado toast.
Yeah.
If I'd have just cut out the avocado toast, I would be able to afford 10 properties like they used to be able to 50 years ago.
The avocado toast ruined a generation of home buying dreams.
Mate, to be honest, how good is avocado toast? I don't mind.
Not bad.
I don't mind some avocado on toast, a little bit of Vegemite, a couple of post kegs, if that still counts. Yep, cost me $15 or $20, but is that stopping me from building wealth?
Do you reckon that and your coffee has cut you out from having 10 properties at the moment? Or do you reckon there's some other things that we might be able to do with your money that we can maybe get you into that first property or into that first investment property?
I reckon the latte lie is a lie. Yes, I do love coffee. Yes, I do love avocado toast. Is it holding me back from my financial dreams? No, I don't believe so. We're going to go through some things around that are bigger wins rather than cutting out your latte. If you enjoy your life, as Jared and I have spoken about before, we think that you should, each and every day. Have it factored in, but don't cut it out because we're trying to scrimp and save everywhere off a $5 latte. Enjoy your life.
And we'll weigh up those figures as well. And we'll compare it to a real life example last week where we saved someone $4,500 a year on their interest bill on their home loan. They hadn't reviewed that for a couple of years. And let's weigh up the difference between what you can do that's a tangible outcome versus what you can do with your daily latte.
It's pretty topical at the moment, especially with interest rates. People haven't reviewed their home loans in a little while. $4,500, that's a fair few coffees that you may be able to buy. If a cup of coffee is $5, that's 100 cups of coffee. If you're having one a day, that's a third of the year. So I think you should still enjoy your cup of coffee if you're having them every single day. You get 1/3 of the year free coffees. Not a bad outcome.
Now, where did this little lie come from? This is something that's come from finance gurus and people talking on clickbait shows for a very long time, where these small little finance blips will sink big ships. And whether that's true or not, there's a lot to be said for both sides of the argument. But it is true that consistent habits do build over a long period of time. And as we've spoken about in other episodes, that compound effect over a long period of time can have a massive impact. But we're here today to talk about what other things can we do apart from focusing on our micro spend that will have a big macro benefit.
Yes, Jared, we've quite rightly spoken about, and we will continue until the cows come home, that automate as much as you can, set up yourself, put it into the right investments, put yourself into the right position, and it's not your little micro spending that's going to build wealth. I think Warren Buffett, and I'll go back to him, I love his analogies with everything that he has. He used to drink 5 Cokes a day. So, if you're going to put that into coffees, that's 5 coffees a day. Did it really affect his $120 billion worth of net worth? No. He was making other decisions that far outweighed the small price of a little luxury in his life in a day-to-day basis. It's not the $5 coffee. It's the $500,000 mortgage that you've got, a little bit of bad debt that you haven't reviewed. You haven't reviewed the interest rates. It might be the $500,000 in superannuation that you're getting overcharged with fees for. It could be the personal loan or the zip pay loan that you're currently paying off, or the credit card loan that's at 18 or 22%. They're some wins that you can have that are going to compound your wealth more so than knocking out your $5 coffee.
Absolutely. Now, what are some of these other habits that we can build in and we can look at? Looking at things like smart debt structuring. So if we have a look at somebody who's got an owner-occupied home loan and an investment home loan, they've set them both up at the start as principal and interest repayments. By simply changing that investment loan to interest only, with some accountant advice, obviously, general in nature, as we always say, and changing that to interest only, redirecting those extra savings that you've got there into your principal place of residence or your non-deductible debt. Things like that can save you an extra couple of $1,000s a year through cash flow, but also optimizing your interest expense on your deductible loan, which is what you want.
Yep, absolutely. You may select the right property and you may sell that property in the future and you've got a capital gains tax of, let's call it $200,000 to pay to the government. Or you could simply put some money into superannuation, save on your tax bill, and let's say that you could put $50,000 into your superannuation as a concessional contribution, knocking out $25,000 in tax if you're in the highest marginal tax bracket because you've sold your house. Well, you're going to get around a $20,000 to $25,000 saving. That's a lot of coffees just by being smarter with your money, and it'd be a better strategic option for you to make sure you're maximising what you've got rather than cutting out your coffees and going through the stress of micromanaging every single transaction that you've got. I know my wife's happy when I don't micromanage her daily habits or daily spends. We've got our budget set up, and as dirty word as a budget is, we spend what we like to within reason on enjoying life now for us and our kids.
Kerrod, you're obviously the expert, and this is your wheelhouse when you talk about superannuation, but tell me more about how those impacts, either as one-off transactions or weekly or fortnightly transactions into your super fund, can have benefits like you've mentioned.
Absolutely. It's a great way to save tax because the superannuation platform it's not an investment, it's a tax effective structure to hold investments. So if you can dump some more money on a regular basis, if you would like, through your employer by making contributions, and let's say that you're getting $120,000 worth of wage, so you're nearly in that 32 cents in the dollar tax bracket, it's at 30 cents to the dollar. 15 cents goes into tax inside super, but you get to claim the difference. So if you're putting in $100 a week, means that $70 goes into your super, you get to claim $30 of it as a tax refund. Putting a little bit more money into superannuation, you get to claim those extra couple of coffees on the government while you're continuing to build wealth. Superannuation, yes, great way to build wealth, and it's also a nice little tax savings, which is going to weigh up the benefits and outweigh the benefits of cutting back on your coffee.
Excellent. And if we have a look at the compound effect over a long period of time, like we've spoken about, that will obviously have huge impact. But also, if you look to revisit your superannuation investments, what sort of adjustments could you potentially make there that would then have an impact for you over a long period of time? And let's assume this is for mum and dad in their early 30s and they've got 30 years worth of work ahead of them.
Yeah, absolutely. You can review your superannuation. We've all seen the ads where they've got the little triangle, I think it is, if I'm doing a triangle with my hand, if you're watching or if you're listening, it wasn't a great triangle or diamond shape that they have, but everyone's seen the ads, compare the pair, same industry fund, same superannuation contribution, same age, but you can have a look at the investment, and I would always have a look at the underlying investment costs because they're going to differentiate between each superannuation platform. The underlying investments will perform around the same. They're nearly, and generally, this is general advice only, all invested in the same sorts of assets. If you can really cut down your investment fees on a percentage basis, it can save you not only in the first year hundreds, if not thousands of dollars, but you compound the tax or the savings that you get in investment fees over a 20, 30 year time period for the average 30-year-old. It works out to be hundreds of thousands of dollars. Have your coffee, but check your superannuation fund.
And something else you can do with that as well is one of our favorite words is automation. So build that into your budget. Like you said, build it into a salary sacrifice arrangement where it can be done every week, every fortnight. You're not even going to miss it.
Absolutely. Jared, talking about superannuation, all things superannuation. What about debts? If people have got their owner-occupied debt, plus also their investment property debt, and they're trying to save a little bit of money, keep their tax down by having the good debt, how would they go about structuring their family home versus their investment property?
Pretty common theme here of reviewing stuff. So reviewing it at an early stage and reviewing it often, whether it's your superannuation or whether it is your home loans, is going to pay dividends over the long term. So a lot of the time, lenders will assume that people aren't going to be reviewing their stuff actively, and if they're not at least every year, they'll creep into what's called a loyalty tax, where their rate will slide and they'll be an older client, new lending is always priced a little bit differently, a little bit sharper. So if somebody's shopping around or having their broker shop around for them on their behalf every single year, that's going to continually save them a rate. And even if it's 0.02, 0.05, that compounded over a 30-year period is going to have a massive, massive impact.
Loyalty tax or cut your coffees? Which one would you have a look at when you're reviewing your things?
It's crazy to think, isn't it, that you can make little changes like this, and if there is still, those little indulgences that you love that you don't want to give up, you don't necessarily have to, and you could still be significantly better off over time. Another thing is, if we're coming into an environment where rates are going to start to steadily creep down, the impact that will have to your weekly or fortnightly repayment is that on the average home loan of $600,000 with a rate cut, you can probably drop by about $120. Do you want to do that, or do you want to keep that repayment where it is and leave it over the long term and pay that loan off a year or two earlier by doing so? So again, you're not affecting your budget because your cash flow hasn't changed whatsoever. The market externally has changed and you're just leaving your exact same budget where it is.
Loyalty tax. Isn't it a painful thing that the banks just think that you're going to be loyal to them and they continue to charge you a higher rate than trying to get new customers in the door? I don't think that it only stops at banks though with a loyalty tax. You've got your insurance companies who will apply the same method. You've got your energy companies who will apply the same method. Even your mobile phone provider will also apply the same method. So before you go cutting your coffees, make sure first you review your big ticket items, your home loans, your investment loans. If you've got any credit cards, get rid of them. We've spoke about them before, chop them up. Review your energy provider, review your insurance provider, review your phone bill provider, all of them. I would go through all of that before I cut out any of the coffees because there are much larger wins which are going to have a larger compounding effect over time.
And the energy one can be a big one as well because you quite often will get a 12-month discount on that, which is 25%, 30%, but relying on the fact that people aren't going to check, people aren't going to follow up, that is something that people need to be hyper vigilant with. And even insurances, like I've seen examples where people get re-quoted under husband's name, wife's name, partner's name, for the exact same policy, for the exact same details, coverage amounts, things like that, difference in premium from new customer to existing renewal. So things like that where you can go around and get re-quoted. There's plenty of sites and plenty of really good insurance brokers out there that enable people to chase and get the best possible quality cover for what they need, because that is also super important, but also for a more competitive price than what they're getting there. So being able to then also put that away into these compounded long-term investments is going to pay massive dividends over the long term.
Make sure you're not getting ripped off because they will do it to you, and they take the nicety of Australians and how we are generally, that we're not going to look at things they're in my best interest or they're not. They're out to make a profit for themselves. You need to have the same mindset for yourself and your family that you're going to profit off them. So play them off each other. Play some banks off each other through a broker, play some insurers off each other, play the mobile phone providers. Whoever's going to give you the best deal at the cheapest rate for whatever you want is going to have a far bigger effect on your cash flow and your wealth building ability over the lifetime of your life, rather than cutting out your coffee and the things that you really love.
There's a pretty consistent theme here to big business, isn't there? When we're looking at superannuation, banks, energy providers, insurance and phones. They're all big businesses, and they do rely on the ability of Australians to just forget things and be a bit lazy on it. And it's our responsibility to remind people not to be.
Exactly. 5 things that you should focus on this year, Jared. We spoke about the top one. With the interest rates coming down, you should be reviewing your home loan and your investment loan, because there are some big changes that you can have which have large effects on our wealth building ability, and repaying some of that debt. Get rid of the banks as much as you can. Yes, have good debt, get rid of all your bad debt. What's something else that we may look at this year if we've got 5 steps? Your home loans.
Let's look to build an emergency fund, and let's place that in our offset account against our owner-occupied home loan. Number 1, that's going to give you a bit of safety and security. But number 2, that's also going to reduce the amount of non-deductible interest that you're paying on your home loan, which will then enable you to pay it off faster with the exact same repayment. Example here is if you've got a home loan for $500,000, you've got $50,000 sitting in an offset account, your repayment isn't going to change and you're still going to be paying the same weekly, fortnightly or monthly amount. But it's calculated on an interest amount of $450,000, which is the difference between your owner-occupied balance and your offset balance.
With interest rates at 6% on $50,000, it's not too bad in interest savings each year, which comes straight off the principal.
Yep.
I love it. If you slight little plug here, if you're looking to build a cash buffer, go back a couple episodes and listen to why cash buffers save marriages. Jared has outlined it articulately for everyone. So go back and have a listen.
Number 3, part of your wheelhouse. Revisit the superannuation investments and see if they're aligned with your risk portfolio. So that's going to be something that you can compound on a weekly basis, but also remanage and rejig over a long term.
Yeah, absolutely. And this shouldn't just be done when you're getting closer to retirement. The earlier you can have a look at the investment and administration fees and how that superannuation is invested is going to have a very large impact on the money that you've got when you do retire, and you can access your superannuation at age 60. So review how it's invested, review the cost of that investment, make sure it's a cracking provider so that you can benefit long term, and it's working hard for you now, so to maximise your benefits when you do get to retirement. And yes, you can have a look at all of them. There are tools online that you can have a look at and compare my superannuation fund. There are different investment options. If you want an expert opinion, there are 500 advisors in Newcastle, 15,000 in Australia, or there's one very good one up here at Charlestown if you would like someone else to review your superannuation for you. Jared, we're looking now to borrow some more wealth, borrow some more debt, what we should be looking at.
What about learning our borrowing power and not guessing? So looking at, and that also couples with the reviewing of your home loan at the same time, and looking at what your current rate is, looking what the market rate is, and looking what you can potentially borrow on top of that. Because if you want to make some of these changes and you've made enough changes to maybe access an extra $500 a month or $1,000 a month, that could then potentially go to an investment. Why don't you look at some borrowing there and see if you can leverage to potentially have a play around in the share market, do something around some debt recycling, which we might touch on in another episode, and look at how you can build wealth off the back of those savings that you've done.
One of my favourite topics, debt recycling. Get out of bad debt, get yourself into good, some tax deductible debt. While we've got negative gearing here in Australia, you should be taking advantage of it. We've had a look at our borrowing power. Now, Jared, your favourite topic, automating.
Our favourite topic, automating those savings and reinvesting it. So working out what those savings look like, and let's break it down on an annual basis and what you've been able to save now on your home loan, what you're saving in tax from some super contributions, what you've saved overall from energy, phone and insurances, and let's package that up. And if that works out to be $50 a week or $100 a week, let's either automate it into a savings account or an offset account, like we've said. Let's potentially do that as an extra home loan repayment. Let's work out where that's going to be most effective for you and work well.
After you do have your expenses buffer in there, your 3 months worth of expenses in a cash buffer sitting in the offset account, we've spoken about it numerous times. If you were to invest $1,000 per month, $12,000 per year, that's all it is. And you started when you were 20 and you finished at age 60, so for 40 years, if you could just continue to do that for 40 years, you would end up with over $1 million sitting in an investment account. It's much like what your superannuation balance is going to be, but you'll have that outside of super. Whereas if you start just 10 years later, that balance works out to be $300,000. So you miss out on $700,000 by starting 10 years later. The power of compounding. Go through with a fine-tooth comb, have a look at where you may be able to save some money on some different things that you've got going on in your life and your expenses, and put it to building wealth for you so that you can get out of the rat race and get to living life on your terms. Small habits, but big strategies win over the long term. We spoke about compounding, cash buffers that save marriages, automating your finances, making sure we review our big ticket items so we can still have our lattes.
What's one big lever you think you could pull as a listener and help out with your finances? I'd love to hear from people in the comments section, whether this is on YouTube or Spotify or Apple, or even in our DMs, and let us know. We might send out a sneaky prize next week for a listener that comments on what they're going to pull to enhance their financial future.
A sneaky prize, yes. Yeah. I know Crown Property Finance have got some cracking shirts, but it might be a little bit better than that. So yes, for me personally, I always like to review the interest rates on my mortgages, especially when they're coming down, to make sure that my bank's in check. and review that with a cracking mortgage broker. I also like to go through the energy prices. Being an old Sparky that I am, I go through and have a look at what the kilowatt hours are that I'm being charged and my connection charge, because they change all the time. And the way that energy prices here in Australia, they're absolutely ridiculous. So reviewing that on an annual basis is something that I do for me and my family. And we use a little bit of those savings to enjoy ourselves rather than giving it to an energy company who I think are taking advantage of everyday Aussies when they shouldn't be. Jared, what about you? What is something that you have a look at each year?
Yeah, energy on an annual basis, contacting our phone and internet provider, because everything's packaged up in the one. So every year or so, we get in touch with that as well as obviously home loan rates, which I'm pretty all over.
Yes, I've got no doubt you'll be all over home loan rates, especially for yourself and for your clients over the next 12 months with interest rates as they continue to move down. Now, I hope that they continue to move down in line with what the NAB's projecting, which is 1% to 1.5% over the next 12 months, which would be nice. Give a little bit more breathing space, but we've spoken about the benefits of continuing your same repayments, which will allow you to make some extra contributions to your home loan, build up a little bit of a cash buffer, whether that be through in a redraw or in an offset account. They work a similar way for a principal place of residence. Keep it there, build up your cash buffer, and then look for other investments after that stage. But this podcast is general in nature. Please seek personal financial advice if that's going to be the option that you go down. This is just general information only, and there are plenty of professionals out there.
Absolutely. Thank you very much for tuning in this week. We look forward to chatting to you all again next week. Don't forget to leave a comment in one of the socials or where you find this podcast, and we'll pick out a sneaky winner next week.
Thank you.